Hello Sector Watchers, welcome to the show. This is the 138th episode of Sector Spotlight for Tuesday the 2nd of August, and I am recording it on Monday the 1st. My name is Julius the Kempenaer and I am presenting to you from Amsterdam in the Netherlands. You can find my contact details on the screen in case you want to reach out. Today will be a busy show. Last week was the last Tuesday of the month, and usually we cover seasonality in that show. But last week we introduced intraday RRGs, so we had no time to cover seasonality. By the way, I love to hear what you think about the intraday RRGs, if you are using them, what is your best time frame, anything you want to share about that, and how you look at things differently now that you've got that tool available. I am all ears. That's the reason why today I will cover both seasonality and the monthly charts, because it is the first Tuesday of the month where we usually look at the completed monthly bars for July in this case. So the agenda for today looks like we're going to have a very quick look at the current positioning of sectors, current sector rotation. Then we'll move to seasonality. I'll look at a few of the individual sector charts in combination with the seasonality, so we're not going to go over all these charts individually. And then when we do the monthly, of course we are going over the monthly bar charts for July. So no time to waste, ladies and gentlemen, this is Sector Spotlight. On the left-hand side, we have the RRG for the 11 S&P sectors. And the one thing that immediately stands out is the fact that at the moment there is no sector inside the leading quadrant, not a single sector is inside the leading quadrant. There is a few in lagging, financials is in there. Materials just crossed over, and real estate is kind of on the edge of the weakening and the lagging quadrant. Means that the bulk is now spread out between improving and weakening. And that means that we have a market that is in transition, and that is following what we discussed a couple of weeks ago, that growth is picking up and money is moving to growth stocks for now, because it's unclear. At least for me, it's unclear whether this is the end, this is it, this is now everything's going back to growth and the S&P has seen the bottom and will start to move higher and eventually push to new all-time highs, or this is still a hiccup in the downtrend that we are currently seeing. Personally, I need a little bit more evidence before I would feel comfortable calling the end of this corrective move, the end of this downtrend, and the market to move higher. Nevertheless, we're going to take a look at what's going on in this sector rotation. We're going to take a look at seasonality. We're going to take a look at the monthly charts, and I think that especially the monthly charts, when you take a step back, could give us some good insights on how the various sectors and the S&P itself is currently positioned in a longer term time frame. Again, the sectors are now spread out between improving and weakening, and discretionary and technology, XLY and XLK together make up almost half of the S&P 500. So that's the reason why the majority of these sectors is inside the weakening quadrant, because they need to provide the counterbalance in terms of market capitalization to keep this graph in balance, and if XLY and XLK is pushing the one side, then we do have to have a number of sectors moving the other side, and that is exactly what you see happening right now. You know that we started breaking down these sectors in three groups, offensive, defensive, and sensitive. And if I bring that up next to the one that you already see here, then I think that paints that picture even better. So this is exactly the same RRG, but the right one has now the offensive sectors. And what you can see is that materials, real estate, financials, they're all showing tails that are not fantastic. The only tail that's really good is for consumer discretionary, and we all know how that's happening, and that is a big sector. And that is what's driving the market right now. That is what's driving the S&P 500 up, predominantly the moves inside the consumer discretionary sector. If you broaden the view to all offensive sectors, then you can see that financials and materials, and to a lesser extent real estate, are actually still weakening versus the S&P 500. If I bring in the defensive group of sectors, then you can see that they are all still on the right-hand side of the graph. Utilities, staples, and healthcare. They're inside weakening, but they're way up on the RS ratio scale. So the question here is whether these tails are now heading towards the lagging quadrant and really begin a new relative downtrend versus the S&P 500, or are they simply going through a temporary setback, and will they curl back up and move towards the leading quadrant before they hit lagging? Given the high readings on the RS ratio scale, I am still in the latter camp. I think that these sectors still have all the possibilities of curling back up and moving back up to leading. Time will only tell, but given the situation, given these tails, that's my opinion based on current sector rotation. If we finalize that with a look at the sensitive sectors, then we can see that also here, 3 out of 4 are showing tails that are at a negative RRG heading. We got communication services, insight improving, it's already rolling over. We talked about that last week. You see that industrials tried a short stint into leading, but then rolled over, is now inside weakening. And then there is energy, of course, showing that very long tail going through weakening, however, still at a very high reading on the RS ratio scale. So just like the defensive sectors, energy still has all the possibilities to curl back up. But here also, only technology on a positive heading, and that wraps it up in the chart on the left, where you see discretionary and technology basically leading the market higher right now. Whether that is the start of a new major leg upward in the S&P 500 or still a temporary hiccup within the current downtrend, as I said, again, too early for me to tell, but I'm definitely keeping an eye. It is definitely possible. Looking at the S&P 500, here's the weekly chart, and we bounced off that support around 360. I think that the next really important level that we need to watch is between 415 and 420. That in the coming week, maybe next week, will be important. If we take that out, there is more in store for the S&P 500. We could go higher, and you will then get gradually more and more evidence that the bottom is in. But we're not there yet. The S&P 500 daily, you can see how that move is playing out, and you can also see in more detail how important that 415, 417 is. But you can also see how littered the upside is with resistance levels. So even if this was the bottom, if this was the low, and we're on our way for a new long-term uptrend, it will not be a straight line up, because there is a lot of resistance that needs to be taken out, and I'm pretty sure that one or more of these resistance level will play their act and push the S&P down. And the more we get higher lows in place, the more confident that we can get that the market will be moving higher. For our take on seasonality, I want to try a different layout of the screen for this occasion. You probably have seen these graphs, these Excel graphs before, and I usually pulled them up one after the other, but I think it's interesting to see them combined and also have a chart that aligns with that on the other side. This one is maybe too small. I just wanted to show you how they are stacked on top of each other, and I am now going to blow them up a little bit, but then they go off the screen. So I hope this works when I move. Yeah, that works, so that's cool. If we start with the chart of the months, the average number of months of outperformance over the S&P 500. And there's really only one sector that really stands out in August, and that's technology. 70% of the time, technology outperformed the S&P 500 over the past 20 years. If we go one tier lower, then maybe utilities and healthcare with 60% could play a role. And then on the other side, in the underperformance, we've got materials with 35, so 65% of the time, materials underperformed. And the same level communication services and energy. And if we look at the accompanying performance figures, then we see that materials actually underperformed on average 70 basis points. So that aligns with that very low number of outperformance, so that's cool. If we go to communication services, then a flat performance doesn't really support a strong underperformance for communication services in this month. It does for energy. 65% of the time, the energy sector underperformed the S&P 500, and the average underperformance was 1.7% below the S&P 500. So that's definitely something to keep an eye on. And then we have technology, as I said, 70% of the time outperformance, and the number that belongs to that is 80 basis points over the S&P 500. Utilities, 60% of the time outperformance, and the number there is 30 basis points over. And then here, healthcare doesn't match because the majority of the time, or at least 60%, as I said, it's not a very significant number, but it's way above 50, but still I'd prefer 70 or higher. But the average performance for healthcare in the month of August is 20 bips below the S&P 500. Now let's bring in some of these charts. If we start with materials, we know that on the RRG, that tail is strongly down and pointing and already inside the lagging quadrant. And if we look at the price chart, then that I can see that happening, and I can see that underperformance coming in. Because I do think that materials have rallied back to the breakout level almost, and I wouldn't be surprised if we're making a new high against resistance here, which will eventually push that relative strength lower again. So materials could definitely be a sector underperforming the S&P 500 based on seasonality going into the month of August. If we look at communication services, then here also, I mean, from a relative point of view, I wouldn't be surprised if we would see another month of underperformance for communication services. However, the expected return is flat. That is not something that really aligns for me. The price chart does. The price chart aligns with that low seasonality number, so does the raw relative strength, but the expected performance doesn't really kick in. Not really. If we go to energy, then we can see that that is obviously still very strong. We had that massive decline. It looked very big, but if you put it into perspective, it's not all that bad. And the former resistance level perfectly acted as support, so you got to give him that. And we're now bouncing upward, and that is starting to drag the relative strength line back up. That doesn't really correspond with a strong underperformance in the month of August for energy, especially not a big number like 1.7 below the S&P 500. I I mean, these numbers together would suggest that energy was very likely to underperform the S&P 500. However, when I combine that with the actual current rotation, I think that I would fade such a trade, because I do think that that longer term trend is still higher. We just went through that massive decline. Former resistance is now acting as support, likely to catch any declines. And the RS ratio line is at a level above 100, where the rotation can take place on the right hand side and curl that line back up before it hits the lagging quadrant. So for the energy sector, I don't think there is really a tradable opportunity based on seasonality. We go to the technology sector, and we see that that is continuing to improve. We're breaking out of that trend channel. What I really like is the fact that we're getting out of that trading range in terms of relative strength. That is pushing that tail further up inside improving and potentially into leading. And that would definitely align with a strong month of August for the technology sector, including a good return of 80 bips over SPY. So the technology sector aligns, the seasonal pattern of technology aligns with the current rotation. So that is, I think, something that could be seen as a tradable opportunity, just like materials on the downside. And then we have utilities. Utilities are 60% of the time outperforming, and then the expected return is 30 bips. We are currently going through a little bit of a setback on the RRG, on the current rotations. To me, that's not an align. The number is too low. The 60% is not really what you want. You want it to be at least higher than 60, 65, 70 would be great. But it's not there. And then the expected return, 30 bips over SPY, is also not something that you would bet the farm on. So I'm gonna leave it at that for utilities. And then finally we have healthcare. Healthcare is still inside its range. It's losing relative strength. We saw that tail going into the weakening quadrant. For the coming months, coming 4 weeks, that doesn't align. That current picture doesn't really align with an outperformance for the healthcare sector in August, especially with an expected negative return of 20 basis points. So an outperformance with an expected return of 20 basis points and a price chart that's basically caught in a trading range. I don't think that's worth our time, effort, let alone our money as an investment. So what can we learn from the current seasonal and the actual rotations? I think that materials are lined up for a month of underperformance, and technology is lined up for a month of outperformance. For the monthly charts, I'm going to work off my Sector Spotlight chart list, which is a public chart list now since last month. I'll put the link in the description of the video so you can access this list, including the annotations as I have made them. Let's kick off with the monthly chart for communication services. And I think the picture that we see here is what we will see in a lot of charts. A monthly chart that shows a sector moving down and hitting on long-term support levels and bouncing off that level. So these old resistance levels returning as support. We will see that in a lot of charts. And I think that's the general picture in the market right now for a lot of sectors. We are coming down, we're in a lot of downtrends, and we are bouncing off support. Does that mean that this was it? I don't know, and we'll look at the charts later on. So here is communication services bouncing off that long-term support level. There's a bit of upside but the trend is still down. If you look at consumer discretionary, here also finding support at a former resistance level. It's a horizontal as well as an old upsloping trend line, and the market bounced strongly off that support level. So we're right here right now, around 1280. But that downtrend is still fully intact. There's no doubt about it, and there's a lot more price action needed to turn this back up into an uptrend on the monthly time frame. Here is consumer staples that found support and is bouncing upward, but there's no trend. There's no downtrend, no uptrend. It's in a sideways move. So remember, it doesn't always have to be an uptrend or a downtrend. An uptrend is higher highs, higher lows. A downtrend is lower highs, lower lows. But it's definitely possible that you got neither one of them, and then you're in a sideways move in a range type of situation, and that's what we see in the staples sector. Here is energy, definitely still in an uptrend, came down, found support, and is now bouncing off that support level and moving higher. If you look at financials, bouncing back to bouncing off an old resistance level that is now acting as support. But look at the toppish formation that we've set here. Look at that overhead resistance that's waiting for us around 585. So it looks nice in the near term that we're bouncing off this support level and we're moving higher right now, but there's a lot of resistance waiting just around the corner basically, and that goes for a lot of sectors. Here is healthcare, found support with a little dip in the month of June, but in July we managed to stay above that support level and we're inside that range. Still going strong, but not a real strong uptrend anymore. Here is industrials. That top formation was completed. That is a downtrend right now, despite the fact that we saw that we found support both in June and July. July marked at the start of a strong rally. We moved from below 725 to over 800, but around 825 there is a lot of resistance waiting for us again. So again, I don't see this as the start of a new move higher. There's a lot of overhead resistance, in this case in the industrial sector. Here's technology, same story. We found support at a long-term former resistance level, acted as support in March 2021, did it again basically for 3 months already. So look at here, May it was 2215, in June it was 2136, and in July the low was 2186. So around that 2200 area there is constant support, but supply is expected around 2600, because this is, no matter how you look at it, a series of lower highs and lower lows on the monthly time frame. This isn't going to turn around just like that. It needs time, it needs a lot of money to move that around, and it's not going to be in a V shape. Here is materials. Again, found support and is bouncing back, but is now almost back at its breakout level. So where old resistance levels are coming back as support, we will also see the reverse, where old support levels are now getting back as resistance for these monthly charts. So we'll have to wait and see how far the rally in materials can go, but I think that around 500, there's a lot of overhead resistance waiting for the materials sector. Here is real estate, lower highs, lower lows. Again, an old support level, we're bouncing off it, but there's still a lot of overhead resistance waiting. We go to utilities, same story. We bounced off support already last month, and we're now pushing higher. This is one of the few sectors that's still in an uptrend. It's a very defensive sector. It's almost pushing to new all-time highs. We'll have to see how that goes. And then if we wrap all this up into the S&P 500, then here also the rhythm of lower highs and lower lows is intact. You can see that the S&P found support around 3600, which was the high in September 2020. And there is a ton of resistance waiting for us. The first one is around that 420 area that we saw when we covered the current rotations. But even we could go to 4600, and then in the monthly time frame, we would still not have a higher high. So I remain very cautious for what's going on in sectors, even with the current bounce as we see it unfolding right now. As usual, I've wrapped all this information up in a table, and what we see here is that there were no changes in up or down trends, at least in my world, in my book, and how I labeled them, and that's very judgmental and it's very subjective, but that's what I do every month. 18.5% of market cap is in an uptrend. Those are primarily the defensive sectors plus energy. And then in a downtrend, 65% of market capitalization. That's the way, adding the weights that you see in this column here. The support and resistance levels, hardly any changes. But what's interesting and what struck me most is when you look at the column of downside risk and upside potential, then you can see that the downside risk is now significantly bigger than the upside potential. And that is something that keeps me, well, it's not going to keep me awake at night, but it keeps me on my toes, because in a situation where a market is providing me more downside risk than upside potential, as an investor, I think I need to be careful. And I'd like to see this flipped around with more upside potential than downside risk, and a lot more uptrends to call the S&P 500 back into its secular bull market. We'll have to wait and see how long it takes, how much time we need for that to happen again. And that wraps up Sector Spotlight again. Thank you for watching. And please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Looking forward to see you again next week, same time, same place, at a new episode of Sector Spotlight.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.